Well, I'll go ahead and
Okay, thank you.
All right, so I'm gonna go ahead and start until we get Clint here, and then he can take over.
Okay,
We'll just wait for another minute because it's just now 2 o'clock my time.
okay.
Is Olympia coming on?
I hope so. I sent her the invite. I accidentally didn't send here. I'll text her now.
I gotta make sure my people. I have a couple people that are coming on for the back end stuff. I just need to make sure that they have the login. I'm sure they do. I shared it with them. Mo. Uh-oh, did I not send this to her? Mo. Neek Thompson. Did I send this one with her? Oh, shoot. And Lydia. Okay. Let me go tell her real quick. I didn't send that to you. That training is right now. I just sent you. All righty. Let me go ahead and just give you guys a little update on what's happening. Hello everyone. Nice to see you, Chuck, Karen, Teresa. Those of you who I can't see, nice to see your names on here. I'm glad you guys are getting some additional training on the new products. So I'm sure Teresa has shared with you that there is a lot of new stuff happening through Lean.
Does Sonia take these after?
Yeah. I put you on mute, Debbie. Okay, so what's really cool is we do have some information, or I do have some information, hey Selena, about ERC. So I'll just give that to you. So as you know, ERC submissions stopped on January 31st. What we're doing is we're waiting for the Appropriations Committee to appropriate the funds for the remainder of the ERC deals that have been submitted before January 1st or January 31st of this year. So we hope within the next 30 days that the Senate will pass the bill that is on the floor for them to pass. And then once they pass that, we anticipate the Appropriations Committee will meet as long as the budget is also approved. So we think within the next 30 to 60 days, they'll start paying off those cases again, but we don't know for sure. So we do give updates on Tuesday at 10 a.m. Pacific Standard Time. The call is in your Appreciation Financial back office on the calendar. It's called the business call. So every time I have an update, I always give them on that call. But today what we're going to do is we're going to talk primarily about cost segregation. I know many of you are excited about this. We have our expert Clint on, and he is going to be able to answer any of your questions as well as give you some information. So Clint, welcome. And
thank you. Thanks for having me.
Share. You have access to share. And then I know Teresa has some questions too. So you can take it away if you want to go ahead and get started.
Very cool. Would you prefer that we just kind of run through the normal presentation and go through it fairly quickly and then have people write down questions, or do you want to take some questions at the beginning? What would you prefer?
Teresa, how do you want to do it? You're on mute.
Yeah, I think the overview is good because I gave them the little tidbit that I remembered from the overview a couple weeks ago, and that's all I have so far.
All right, yeah. So start with the presentation and then we'll go from there.
Okay.
Just write down any questions. You can put them in the chat, and then at the appropriate time, I can stop you, Clint, and ask your questions for you.
Okay, sounds good. I will go ahead and share. Okay, everybody can see that?
Yes.
Yeah.
Okay, good. If I hit slideshow, does it, I don't know if it messes it up or not. Let's see.
No, it just
Oh, there-
should make it big. So it's coming. Give it a second. It's not. Okay, we can see it now. Go for it.
Okay, sounds good. All right, guys, here we go. Cost segregation 101, the 5 W's. I think most of you guys know what the 5 W's are. Who, what, when, where, why. And an H. H is the how. How do we do it? So we're going to talk about what is cost segregation and go through the W's, and then we'll talk about how we work together. Okay, there's that. All right, here we go. This is the nerdy definition of what is cost segregation. As you see there at the top, it says it's the process of identifying building components. Let me stop right there. The entire point of what we're talking about here is number one, cost segregation is a way for people to save federal income taxes. If you remember, and we talked about this when we were in Las Vegas at the event, people pay taxes on whatever their net income is, their net taxable income is. So they get to take what are called deductions. And you guys are well aware as 1099 folks, you take deductions for your business. Well, real estate folks take deductions for their business as well. One of those deductions that they take is called depreciation. And depreciation is real simple. Depreciation is basically when you buy a building or build a building, or you build out a space that you lease, all of the money that you put into any of those things establishes what's called a tax basis. That tax basis becomes a write-off in the form of a depreciation deduction each year for that, whoever owns those assets. So it's real simple. Basically, if there's let's say it's $1 million building, and that $1 million building is, let's say, an office building. The IRS says that it depreciates over 39 and a half years with what's called standard depreciation. So if somebody does standard depreciation, it's 39 and a half years. Divide the $1 million by 39 and a half, and you would get, your depreciation deduction for the year. If it's a property that people live in, then the rules are a little different, and it's 27 and a half years. So you take whatever that tax base is, you divide it. That's called straight line depreciation. That gives you a depreciation deduction for each and every year that you own and operate the property. When I say operate, what I mean is that once a property is placed into service, that's another thing you might want to make a note of. Once a property is placed into service, from that tax year on, it takes this deduction. So if you bought a property a couple years ago and then it took you a year or two to fix it up or whatever, the moment that it's leased.
Browser, if you go to the very top right-hand corner.
I think somebody's talking there. Okay. From the moment that it's leased and is placed into service, that's the tax year that you start taking this depreciation deduction. So now that you have some idea of what the point is here, the depreciation deduction just decreases the taxable income. And if the taxable income is less, then that means you pay a little bit less in taxes. What we're trying to do with cost segregation, or what we are doing with cost segregation, is that we are creating an opportunity to do two things. One, we want to dramatically increase the amount of depreciation deduction that you can take. And we want to accelerate the schedule in which you can take those deductions. The third thing that we're doing, if a property has been in service for a period of years in the past, the third thing that we're doing is that we're going back in time to the time that the property went into service and bringing forward any benefit that we missed out on from not doing cost segregation back then, each and every year from then until now, and bringing forward all of that benefit to this tax year.
Hey, Clint,
So what that means is
there
that,
a limit
yes.
on how far you can go back?
Well, I mean, the technical limit is 1987 because that's when the Supreme Court case that created cost segregation came down. So 1987 is as far back as you could go. But the sweet spot, I would say, is kind of that maybe 5 to 10 year range is going to yield the highest amount in most cases. Again, every case is a little bit different. But in that 5 to 10 year range is going to yield a huge amount. The longer beyond 10 years that it's been, and that just means that they've already taken a depreciation deduction. 5 for a long period of time. And so the amount that we can go back in time and bring forward is less. So that 5 to 10 year range is the best. But honestly, we can still show people a value proposition, even if they just purchased a building, if they're in the middle of building a building right now, or if they just started last year, or even if they started 15 years ago. In any of those situations, it's still going to be beneficial for them to pay the fee, because the tax savings that they're going to receive is going to be a multiple of whatever the fee is that they pay. So the multiple is just going to be variable based upon all those different factors of how long it's been in service and so on. But the bare minimum is going to be 2 to 3 times whatever the fee was. So if someone pays, let's say $1,000, the bare minimum they're going to save is, $2,000, $3,000, $4,000, $5,000. But the maximum that they could save for $1,000 fee could be $20,000 or $40,000 or $100,000. And so you can kind of multiply that out based upon the size of the property and everything else. And so that's literally the range that I've experienced personally, is anywhere from 2 to 3 times all the way up to 40 times what the fee was. So the case that I always bring up is a large hotel worth about $18 million several years ago, before the pandemic, here in Dallas. It was a $40,000 fee, and the first year tax savings was $1.6 million. That's a 40x return on investment, but it's actually even more than that, because the $40,000 was tax deductible. so you could take a third off of that, and it's even more than a 40x rate of return when you consider the tax savings. So it can be dramatic. It can be a huge amount of savings for not a lot of fee in some cases. And in other cases, the fee could be fairly significant, and the savings might not be that much. It might be a $10,000 fee for, 30 or 40,000 in savings. There are other ancillary benefits beyond just the first year tax savings that would still make a whole lot of sense for someone to do. Because literally what we're doing at the end of this story is we are creating a tax credit that is on file with the IRS instantly, as soon as all of the process is completed. The moment that the IRS receives the 3115 form, remember with the ERC, it was a 941 form. 941X was what we were filing. We were making a change and an update to the 941s that were filed previously for those employees. And so with cost segregation, what we're doing is we're filing a different IRS form. It's called 3115, 3115. And we're telling the IRS with that form, we're saying, hey, we've got some income producing property. It's another key term you want to write down. Income producing property. Income producing property. Any income producing property is going to qualify for a depreciation deduction and should be reviewed for cost segregation. So any income producing property. So the second that they receive this information that we're sending a 3115 form, we're telling them, hey, we had this property for several years, and up to this point, we have done what's called straight line depreciation. With the 3115, we're telling them it's a change of accounting form. We're changing the method of accounting for our depreciation from straight line depreciation to cost segregated and accelerated depreciation. And all of the calculation is done there, with the bottom line being showing the exact amount of tax credit that it's going to result in for that taxpayer. The moment the IRS receives that, it's granted automatic consent, meaning that it's not reviewable, because the cost segregation study was done by a third party. So it's not reviewable, not auditable, unless that taxpayer is charged with federal fraud charge, which is extremely tiny percentage chance. I don't even know that that's ever happened with any studies that BDO has ever done. And it's the same net effect as if you wrote a check for that amount to the IRS on that day. 365 days a year, it can be filed. So if you finished your study tomorrow, you send in this form, and when they receive it, if it yielded $1 million tax credit, it would be the same thing as you writing $1 million check and sending it to the IRS. So then the ultimate, value proposition here and the end of the story is, would you pay $40,000 for $1 million of taxes paid in the future? Because remember, this is a tax credit that's on file with the IRS. The answer would be obviously yes, because you know that you're going to pay taxes this year and next year and so on. But even beyond that, you're going to make quarterly estimated tax payments each quarter. So instead of making that next quarterly estimated tax payment, what if you could just use some of that $1 million that's on file with the IRS? How would that change the cash flow for that business? Would the money that they were planning on setting aside, or that they did set aside to make that next quarterly estimated tax payment, is it possible that that money could be used for something else? Is it possible that something else could be something that you bring to them? Maybe that gives them the cash flow that they could either go and buy the next property if they're a real estate investor, so that could result in another cost segregation study for you. Or if they have employees, maybe they could put that into some employee benefits of some kind. Or if they haven't done a fantastic job of planning for their retirement and or their exit from the business in the future or whatever, maybe it could be some type of planning like that with life insurance or some investments or a retirement account or whatever it might be. All things that we can bring to them. What cost segregation does at the end of the day is it creates additional cash flow for that business by creating a tax credit and eliminating their need to make ongoing quarterly estimated payments until that tax credit is exhausted.
Awesome. So there's a
Okay.
question.
Yes.
How much does it accelerate? Example, 10 years instead of 39.5.
Great question. We're getting there, and it's going to be covered in detail. I'll give you the fast answer. The fast answer is that it depends upon the asset. And so we're going to talk about what a cost segregation study is. If you want to write this one down, this is a real easy way to remember what it is. It's an appraisal on steroids. Instead of just appraising the building or the house, this works for rental houses, or if you own a condo or an Airbnb of any kind. It works for any kind of income producing real estate, even if it's a warehouse or self-storage or whatever it might be. So to answer your question, you asked how much is it accelerated? It depends upon the asset. So write down appraisal on steroids. And the reason we're saying appraisal on steroids is that instead of just valuing the building as a whole, like an appraisal would do, $1 million building, how did you arrive at the fact that it was $1 million building, Mr. Appraiser? Well, it's because there were other properties in the area that are comparable to this one that sold in the last little while. And when you take all things into account and you adjust for the size and you adjust for the features, I think that your building or your house is worth $1 million. That's an appraisal. An appraisal on steroids is saying, hey, don't tell me what the entire building is worth. Tell me what each and every component of the building is individually worth. Tell me what each one of the tiles is worth and what the total of all the tile in the building is. Tell me what all the windows are worth and what the total of all the windows is. Tell me how much paint and how much concrete and how much wood and how much steel and how much everything. And value each and every one of those things individually. So imagine taking a house and breaking it apart into Legos, and then taking all those Legos that are different colors and putting those Legos in different buckets. Each one of those buckets depreciates at a different speed. Some of those Legos depreciate in just 5 years instead of 39 and a half years, or instead of 27 and a half years. Some of those Legos are going to depreciate in 10 years. Some are going to depreciate in 15, and so on. And so the question is, to answer the question, back to the original question, how much are we accelerating it? It depends on the building. But the goal here is to try and identify, as you see right here on the screen, it says the process of identifying building components. We're trying to identify as much short life assets, like 5-year depreciable assets, as possible. On average, depending upon the type of property, it might be 20 or 25% of the building can be depreciated in just 5 years instead of 39 and a half. So if that's true, then, and you started, let's say, a couple of years ago with this property, what if you could identify 25% of the value, in this case, $250,000, $250,000, or let's say it was 5 years ago. You identified $250,000 of the $1 million building, And now you get to take all of that depreciation now instead of over 39 and a half years. So now your tax deduction for the year is 250,000 instead of 25, just on those 5-year assets. Then we got to add in the 10-year assets and then the 15-year assets and so on and so forth. It's a really complex spreadsheet that they use to figure all this out. But at the end of the day, we're going to bring forward any benefit that you missed out on from the time you started using the property until now, bring it forward, take it as a big tax deduction now. And that's it. And then down here it says it identifies and reclassifies personal property assets to shorten the depreciation period for taxation purposes, which reduces your current income tax obligations. Again, that's the nerdy CPA way to say it. Basically, what we're doing is we're identifying the short life assets. We're taking a full tax deduction for those. Here's another really cool thing that you guys need to write down. You remember when we used to talk to people about the ERC and we would say, hey, I have good news for you. I know that you were told 2, 3, 4 times by different people that you trusted, including your CPA and your friend and your business associate and so on, that you didn't qualify for ERC. But I have good news for you. The good news is that the rules have changed over the past couple of years. Remember all that? Well, here's another great way to say that exact same thing for cost segregation. With the law that that Holly was talking about, that is about to pass, let's say in the next 30 days or so. Okay, once the Senate gets around to it, there's a whole lot of things going on in the world, by the way, as you all know. But as soon as they get around to it, they're going to pass that law, and it'll be signed into law. Okay, as a part of that, the belief is that if it's as it is now, it will end the ERC early, and then reallocate some of what would have been used for ERC to some other things. One of those things is cost segregation. And one of the ways that cost segregation benefits is called bonus depreciation. Bonus depreciation. All that means is, it just means that whenever you do a cost segregation study, you get to take 100% depreciation of all the 5-year assets, regardless of when you started. So whenever any short life assets, you get to bonus depreciate that or depreciate that instantly. And that just means that it's a bigger tax deduction when you start. That benefits us. It makes our numbers look a lot better. It makes that multiplier or that value proposition of fee versus how much tax savings look better in every single case. So cost segregation benefits with this law passing, which is really cool. The Department of the Treasury said cost segregation is a lucrative tax strategy that should be used in almost every major purchase of commercial real estate. Commercial just means income producing real estate. Here's a brief history. I'm not going to go over hardly any of this other than, as you can see, remember with the ERC timeline, the rules have changed over time. That's it. If you go down here to 2018, it says qualifying assets placed into service after 9/27/17 are eligible for 100% bonus depreciation when cost segregation is applied. Here's what that means. That just means anything that depreciates in 5 years, you get to take it all at once, all 100% of those 5-year assets. And I just told you, depending upon the property, 20 or 25% of the value of that whole property, not including the land. I want you to put a star beside that. Write down, not including the land value. Put a star by it. We're only talking about the structures or the land improvements, not the land itself. Land doesn't depreciate. Land improvements do. By the way, sidewalks, parking lots, trees, landscaping, stuff that's outside the building, all that stuff depreciates. Those are called land improvements. Those are depreciable assets. But the land itself doesn't depreciate. So when we're talking about $1 million building, we're talking about $1 million just for the building, not including the land that it sits on. Okay, so whenever you see a depreciation schedule, it's only based upon just the structure and the land improvements. Okay, next. Who can do? Remember we talked about the 5 W's? Here's the who. Who can perform a cost segregation study? Well, here's what the IRS's chief attorney said. It said, in order for cost segregation to be applied properly, it has to involve those or people with competencies in architecture, engineering, construction, and or construction techniques for personal property assets to be accurately identified and segregated. All that means that doesn't know how buildings are built. So when people ask the question, why didn't my CPA tell me about this? The answer is, well, because the IRS says that they aren't qualified to do it. And here's the next question. Isn't it true that some CPAs try to do it, or at least halfway do it, or do a little bit of it, or try to take some segregated stuff on the depreciation schedule? The answer is yes. Sometimes CPAs try to do it, even though the IRS says they can't. And what happens if that gets audited or looked at? What happens is that the first question in the IRS's audit guide is, Mr. CPA or Ms. CPA, how did you arrive at these numbers? How do you know how much the concrete was in this building? How do you know how much paint and carpet and this and that and so on and so forth? The building was built 10 years ago. How do you know? Do you have receipts for all that? And the answer is, I guessed. Our folks over at BDO, I won't call out names, but they call it a WAG, W-A-G. You can write that one down too. A wild ass guess. Sometimes CPAs make a WAG, a wild ass guess, to come up with this stuff, knowing that they're not qualified and knowing that if they were asked in an audit, that immediately that deduction will be thrown out. Now their client is subject to taxes, interest, and penalties because their deduction will be wiped out. They'll revert back to straight line depreciation, and they probably lost that client as well. So that is why this is serious. That's why CPAs don't talk about cost segregation, is because they're kind of scared of it. Oh, by the way, does that sound familiar to ERC for a whole lot of CPAs? They weren't an
Yes.
expert in ERC. They weren't an expert in ERC, so they didn't want to talk about it. Or they even would poo-poo it. They'd say, oh, you don't qualify. Right? Same way with cost segregation. Sometimes the CPA is going to say, oh, I looked into that for you, and I don't think that would work for you, or that you don't qualify for that, or so on and so forth. And so what we do is we try, just like we did with ERC, we want to come alongside that CPA. We want to do our best to educate them. We want to let them know we're not here to make them look bad. We're here to be understanding that the IRS says that they aren't qualified to do it, and that they just need someone to trust that they can send their clients to.
Then it looks
Ultimately,
like
if
we have
we-
a question by Olympia. Olympia, go ahead.
Yes, go ahead.
A couple of questions. One is the value that's being used, is it replacement value for these personal assets, or was it what it was actually was when it was built?
Great question. It's based upon the value of those individual components at the time that it went in service for that taxpayer.
Okay.
What if the building's 50 years old? Here's a crazy one. What if the building's 50 years old, it fully depreciated while the value kept going up and up and up and up over the years, and then the person who owned the building died and left the building to their heirs, let's say 2 brothers or 2 sisters,
Mm-hmm.
and now they own the building. Guess what? Now the building is reevaluated and has a new tax basis at that moment. Depreciation starts all over again, even though it's the same building that was 50 years old.
That's awesome.
Isn't that amazing? The
That's,
same applies if someone owned a building for 50 years and then sold it to Holly. Holly bought a building that was 50 years old, let's say.
so when
Guess
owner
what?
transferred,
It's a new, even if that building, let's say 50 years ago, the building cost $100,000 to build. Now the building is worth, after all that time and all this, everything that's happened, now the building's worth $1 million. The tax basis is $1 million. When we do the cost segregation study, it's based upon the value of all those components today, not 50 years ago. And it restarts over, and we can do a full accounting and a full cost segregation study. And now Holly gets all the benefits of cost segregation because the schedule starts over completely because she just bought it. Does that make sense for everybody?
that's fantastic. I have one more.
Isn't that
question.
cool? Yes, go ahead.
I live in an area where there's a lot of farmers.
Yes.
growing lots of everything from wine grapes to dairy cows to almonds and all that. So
Okay.
what would apply to them? Would it be them putting in the plants, their equipment? Would their equipment be included or not? Because it's not a fixed. to the land?
When you say equipment, do you mean like farm equipment?
Yeah.
Yeah, farm equipment, no. Land improvements like drainage tile absolutely can depreciate.
And the plants themselves?
But like it's the
Trees? And the plants-
trees, yeah, yes, trees, yes, corn, no. So it
Not-
so
not the
in
product you're growing.
correct, yeah. So for example, the reason I say trees, yes, I'm sharing a little bit about where I'm from. I'm from Northwest Ohio, in the flattest part of the country, literally the flattest area in the entire United States for farmland. And it used to be underwater, and in the Great Depression, they hired a bunch of people, and the federal government paid a bunch of people to dig ditches and trenches by hand to drain the swamp. It was this giant swamp, and guess what was underneath it? Dirt that is like oil, like crude oil. It's black, like potting soil.
Oh,
It's
yeah.
the best soil in the country in Northwest Ohio, right in the little school district where I grew up, the second largest school district in the whole state of Ohio. And it's super fine, like finer than sand. And so that means that when the wind blows, because it's so flat, it'll blow away. We call it a muck storm. A muck storm is kind of like a dust storm back in the day. Remember the dust storms?
Yeah.
It's like that, except imagine black clouds of dust, like covering your car and your house and getting in your hair and everything else. That was what was going on before they started to build or plant cottonwood trees. Cottonwood trees grow super fast. So they would line the field with cottonwood trees to cut the wind in a flat area. So those types of things would be land improvements and could depreciate over time. But the vegetables that they grow in the ground, which, by the way, still to this day, they grow most of the vegetables for Campbell's soup in this rich potting soil like dirt in this little part of Ohio where I grew up in. Crazy. But anyway, so I hope that answers your question. And it takes a lot of drainage because it holds the water really a lot. And so you got to have really good drainage. And so they would put in drainage tile and all that kind of stuff, and all that kind of stuff could depreciate as well. Okay, moving on. Okay, when does cost segregation make sense? So we're talking about the 5 W's. Here's another W. When? Well, number one, the most important question, as you see on the questionnaire, says, have you paid taxes the past 3 to 5 years? So the first question, if somebody says, no, I never pay any taxes. I haven't paid any taxes. I got some real estate. I got a few rental houses, this, that, whatever. No, I don't pay any taxes. I always show a loss, or I have a carry forward loss and I haven't paid taxes. Well, that would indicate that maybe that client, it wouldn't make a whole lot of sense for them to spend a lot of money on cost segregation to create an additional tax credit, because they're not really getting a whole lot of benefit from it this year. Because why? Because they still have a credit on file that they're still working through. Does that make sense for everybody? So in some cases, if someone hasn't paid any taxes, then it might not make sense for them. Okay. A lot of people who own commercial real estate, and let me give you a statistic. Wall Street Journal says that somewhere in the neighborhood, and it varies quite a bit, but even on the low end of the estimate, it's still pretty awesome. 90+% of all the income producing real estate in the country that could use cost segregation does not use it. 90%. That means only 10%. Now, when the Wall Street Journal did this article many years ago, they actually said only 3% uses cost segregation. Since then, there's been some, some say 3, some say 5, some say 10. But nobody says that more than 10%. So that means 9 out of 10 properties, when you're out driving around and you're looking at income producing property everywhere you see, 9 out of 10 times they aren't doing cost segregation. Out of all those people, the question is, the first thing right here, Mr. or Ms. owner of this commercial property or this income producing property, do you pay taxes? Do you pay too much in taxes? Would you like to pay less in taxes? I have good news for you. The good news is that we have a strategy called cost segregation that might be able to help you to pay less in income taxes. if you pay taxes and if you think you pay too much in taxes and you'd like to pay less. We can take a look at it for you at no cost. We'll review everything we need to review. All we need to do is a really quick questionnaire. It's 2 pages. It might take us 5 or 10 minutes just with some basic details of your property. And then within a few days, let's say 3 to 5 business days, we'll get back to you and let you know whether it's going to make sense for you or not. How's that sound? Boom. That simple. Okay, then next, will you pay taxes in the next few years? Yes. Do you have rental properties? Short-term, STR is short-term rentals. LTR is long-term rentals of any size or cost basis. Office, retail, warehouse, self-storage, restaurant, virtually all commercial real estate of any size or cost basis. How about these? Duplexes, triplexes, fourplex, apartment communities. Now it says you must maintain ownership for at least 2 years. Why is that important? If somebody's fixing and flipping a property, then that's going to most of the time be a short-term capital gains situation. And so that's not something that cost segregation helps with unless a 1031 exchange is used. If you don't know what 1031 exchange is, don't get too far in the weeds. Just know that 1031 exchange is a way to defer tax when you are selling a property and have a gain. So Holly bought this property that was a 50-year-old property. She pays $1 million for it. 3 years from now, she sells it for $1.5 million. She has a $500,000 of gain. She can either sell that property and take the $500,000, pay the taxes on that $500,000. In that case, let's say she had it for 5 years. It's a long-term capital gain. She's going to pay taxes. Unless she does what's called a 1031 exchange. 1031 exchange says, hey, the proceeds of the sale go into a trust, and then you have to identify in a short period of time another property to put that whole $1.5 million into. And if you do that within the time frame and with a 1031 company that can help you to do it, then you don't have to pay tax on that $500,000. Also, if you did cost segregation, the benefit of the cost segregation also transfers over to the new property. So if you had a big tax credit, it transfers on over through the 1031 exchange to the new property that Holly bought. And this one was $3 million. And she took the $1.5 million in proceeds from the first one, and then she financed the rest. And now she has a $3 million property. And all the benefit of cost segregation from the first one transfers over to this new property through 1031. Okay. All right. Next. Why can't a CPA do it? Well, we already covered this one. CPAs aren't qualified. We will gladly work with them on a consulting basis. We don't want to make them look bad. We want to make them our partner. We want to help improve and enhance the service that they provide to their client. This
Right.
is one of the number one ways to get referrals is through that CPA. Yes, Holly.
How do we say that to where it doesn't offend a CPA? Because if you tell a CPA they're not qualified to do something, that's not a nice, like, they won't take kindly to that.
I wouldn't say it to them. They know that they aren't.
Okay.
They don't need the reason that they're not doing it. If they were qualified and they felt comfortable doing it and they were an expert, they would be doing it already. Because it's so beneficial to the client and they could charge the client for it.
Right.
But they're not doing it because they aren't an expert and they know the IRS, if they audited them on that, they would throw it out immediately because they aren't even qualified to identify those short life assets.
Okay. Cool.
Yeah. And it says the chief counsel of the IRS issued a memo that made it clear what constitutes proper methodology. So there's a methodology, meaning the who can do it and the how is the methodology that the IRS says have to be implemented in order for it to be granted automatic consent, meaning the IRS automatically agrees with the third party so long as they use the proper methodology and they grant it automatic consent, and the 3115 form creates the tax credit, same net effect as writing a check to the IRS, and it is unreviewable so long as you use the proper methodology. Next, why would somebody want to do this? Well, there's a whole bunch of reasons. I don't know. How about paying too much in taxes and would like to pay less? That's the number one. This says there's a lot of reasons. This actually puts the client in compliance. This is the weirdest thing about cost segregation. It's always drove me nuts ever since I heard this from the first time. I was like, what? That makes no sense whatsoever. The Internal Revenue says, Internal Revenue Code, tax compliance, it says, the IRS says that you are required, if you're going to take deductions for depreciation, would you believe that the tax code requires you to do cost segregation? What? That's crazy. If that's true, then how come no one does it? The default way to do it is straight line depreciation. The reason that they require you to do segregated depreciation is very simple. What happens when you replace your roof on a building, or you replace the HVAC system, or you replace all the flooring in the building? What happens? Well, here's what happens. The roof got damaged by hail, and it's no good. And you've owned the building. This is Holly's building again. And Holly's owned the building for 5 years. And she's been depreciating with straight line depreciation for 5 years out of 39 and a half years. So she's taken a little tax deduction for that roof, right? Because it's a part of the entire $1 million, right? And so when the roof is damaged, the roof has to be taken off and thrown away because it's damaged. It's no good anymore. So if you're just doing straight line depreciation, you throw away the old roof, you put on the new roof, and the CPA goes to the depreciation schedule and puts $100,000, new roof, $100,000 on the building, on the depreciation schedule, and starts depreciating it each year, divides it by 39 and a half, and takes a deduction for that roof. Here's the problem. They didn't change the original depreciation schedule. They just added this roof to it. So now they're taking a depreciation deduction for two different roofs. The one that got damaged and thrown away and the one that got added on. So that's why the IRS says in order to really manage this process of depreciation the right way, you got to know how much each and every component is. Brings me to another benefit. This is a huge benefit. Holly took 5 years out of 39 and a half years of the value of that roof. Let's say it was $100,000 is a depreciation deduction. When it's damaged and you take it off and throw it away, guess what? Because we know the remaining value of that roof, we get to take a full tax deduction for what you threw away because it was damaged. It comes off of the depreciation schedule and goes away, and you take a full deduction for it this year because that was the remaining tax value. Now, when we add the new roof and put $100,000 on there, we're now in compliance with the IRS. If we do it any other way than that, we're instantly out of compliance, which is why when we review these depreciation schedules, 90% of the time, they're inaccurate for that reason exactly what I described. The roof, the HVAC system that got replaced, the tile and the paint and the carpet that got replaced, or whatever renovations were done, or what any of that stuff that went on that got demolished and thrown away, and then something new replaced, that immediately makes the depreciation schedule wrong. Here's the best part. When you do a cost segregation study, guess what happens? You get a brand new depreciation schedule that is cost segregated and accelerated. It has all the components all listed out separately. So you know the value of each one. You know how much you're taking as a deduction. It all gets calculated and tallied to create how much deduction you take this year, next year, and the year after, and the year after, and so on. And guess what happens to the old depreciation schedule? It gets wadded up and thrown in the trash. It goes away completely. Think of this. If it was a whiteboard, it would get erased just like this. Totally erased, totally clean, as if it never happened before, even if there were mistakes made, even if the CPA did it the wrong way, all of it gets erased. You ever play Monopoly and get the get out of jail free card? That's what this is like. Totally brand new depreciation schedule. It's unreviewable now. Now we have a new depreciation schedule that goes back in time 5 years, as if we did the cost seg study 5 years ago. And now we're completely and totally in compliance. And the IRS cannot, even if you're audited, go back and look at the old depreciation schedule. How awesome is that? I mean, come on, we need some applause for that one. That's an amazing benefit right there. Yes, Karen.
So do they kind of get to double dip with this? Because if you're a company and you have this property and you're improving it and you're putting shingles and nails and wood and whatever, and you get to write that off the first time because you're buying all those individual components, and now you're also depreciating it because it's separate, or do you only get it one time if you do this cost segregation?
When you buy it, you're buying the building as is, just like Holly's building that we're talking about. Holly, you need to go buy a building. We'll keep talking about you. So just like Holly's building, she paid $1 million for the building 5 years ago. Okay. Where'd you go?
Yeah,
Oh, there
but
you go, Karen.
then it's not in good condition, so I'm gonna paint and I'm gonna do like all these other improvements. And normally,
Correct.
if I'm gonna do that to get ready for a lease or a renter, then I get to use that as business expenses, right? And ultimately, on the tax form, it doesn't count as, revenue. But like it goes against the revenue, right? So you bring in your revenue, you get to subtract whatever you put into it, and then that's your cost basis.
Where in the world did you get such a smart gal, Holly? I mean, Karen is asking a very intelligent question here. Thank you very much, Karen. You're totally right.
She's mine.
Even though there you go.
I'm
Oh,
all
it's three.
Teresa's.
Even though, yeah, there you go. Even though the paint that was on the wall, okay, this is going to blow your mind. The paint that was on the wall was 15 years old.
Yeah.
The moment that Holly buys it, as far as taxes go and tax basis, that building is worth $1 million, and that's brand new paint, even though it's 15 years old. She gets to start depreciating the 15-year-old paint as if it was brand new for 5 years. When she goes in next year, as she's doing her renovation and replaces that paint, she gets to throw away 4 out of those 5 years for the paint that was already 15 years old. What? Yes, correct. Now she gets to put the new paint on as a separate line item after she threw away the old paint or covered it up or scraped it off the wall or whatever, right? So yes, it is a double dip situation. And guess what? It's not just the paint. It's everything in the building.
So I get to do this depreciation and I get to claim it as a business expense.
Yes. And when you demolish whatever it is you're replacing,
You get the depreciation.
you get the full deduction for what you threw away at the
Okay.
value that it was based on the new value, even though it was old. What? I mean, that's just crazy, right?
Yeah.
That's how it works. So the question is, so why do all these big evil billionaires like, I don't know, the big orange monster guy that was the president, remember him? How do they not pay taxes? This is one of the ways. Just what you described. Just what you described. Buy an old building. Guess what? Tax-wise, it's a new building. Now you depreciate it like it's all brand new everything. Then you go and demolish part of it, throw that part away. You get a full tax deduction for the remaining tax value of what you threw away. And then add the new stuff and start to depreciate that and do it all over again. So it's...
Except this hurts my head a little bit because if I buy a computer for my business, I
Right.
don't get to write off the whole amount of that computer. I have to depreciate it over 5 or 10 years or whatever it is.
Yeah.
Right. So that doesn't count as an expense. But what you're telling me is that if I buy the building and I start depreciating the building right off from get, and then I decide to paint it, I also
Yes.
get to expense the paint and put it into a depreciation cycle.
No. You get to expense the remaining tax value of the old paint.
Okay, so I'm not double dipping like that.
No, not like that, but almost what you're talking
I
about.
get the difference now. But so the difference is that I get to depreciate the old crap that I'm throwing out, and I get the full value for the old crap I'm throwing out. I get the full value of whatever new stuff I'm putting in, but I do not get to expense it as a business expense on the regular accounting.
I know, but think of it this way. What if you buy this building that's 50 years old and the roof was put on 20 years ago and it's worn out and destroyed? Your
Yeah,
tax
I'm not
basis is
saying
still
it's
$1
not
million bucks.
exciting. I'm just trying to understand the details.
Yeah.
So
No, just understand.
when we
Hear what
go
I'm
to
saying.
talk about this, you have to talk about it as if it's a computer or equipment that you're depreciating as a whole thing and not individualized expenses.
Yes, and I would even just recommend not even going into all the detail. Because you'll get way in the weeds with people and they just are going to be like, what? That makes no sense. So it's better just to show them. It's better to actually just, when we show them on the screen, this is what you're doing now.
Okay.
This is what a cost segregation study is going to cost. And this is what you're going to save this year in taxes. It takes all that we're talking about here, all the details, and just wipes all that away. They can ask questions about the details, but the decision is made based upon, this is what you're doing now. Here's what it's going to cost to do the study. And here's your tax benefit now. We're not even taking into account the tax benefit next year when the roof gets damaged and you replace it.
Right.
We can't. We don't know if that's going to happen. Right. But I'm just sharing with you that, if in this situation where we buy this 50-year-old building and now a year from now, we replace the roof, we've only taken 1 year of depreciation on a roof that was already 20 years old. But tax-wise, it was 1 year out of 39 and a half years. So all the rest of that tax value, we get to take as a full tax deduction because we threw it away. Then we put a new roof on. I mean, it's crazy. There's some really neat stuff about it that works like that. That's pretty cool. I think I got a hand up. We got Jenna.
Yep.
Yes.
So I guess I would kind of fit into this person who might qualify for this. I bought a building in 2020, completely gutted it, renovated it, turned it into a salon, and the building's like 80 years old. So
Here we go.
yeah, so I think that's would work for me, which is great. But I'm wondering too, since I didn't get it, I had a valuation done of the building, of course, before I bought it. But for all the value of the things that we gutted and removed, would I be missing out on that opportunity of that depreciation portion of what was left on it?
Man, Jenna, awesome question. Holy smokes. This is maybe two of the best questions I've ever got on a webinar. Wow. Or a meeting like this. So that's a great question. First of all, I'm going to need you to sign a release so that we can have you come on and be a testimonial, because you have an amazing story. And you're going to be like the story of the person who's like, oh my gosh, I had no idea that this was even a thing. And I bought this building and then I gutted it and and you're going to just tell the story and you're going to be like, and I saved this much in taxes this year. What? I mean, crazy. Mm-hmm. So you're going to be an amazing testimonial, right? You're going to use that testimonial with everybody you talk to, but everybody else on this call can also use your testimonial and, change your name to protect you or whatever, if you want to. But anyway, the answer is yes. So anything that was thrown away, so long as you can document it, we just have to have some documentation of, what those things were. And then the way that it actually works, this is crazy. The IRS allows one of these super nerd engineer architect people that do the studies to literally go to your property and look at it, then review all your documentation of everything that was replaced. If you have like photos or appraisal of what the building was before you started and all that kind of stuff, they review all that, and then they can basically reverse engineer. This is an engineer that does engineering, but also reverse engineering. They can reverse engineer all the stuff that got thrown away. And the IRS has some different services that provide values for each component based upon the year it was. So like if this was 10 years ago, the IRS has a service that you can go and check out, okay, how much was this type of tile 10 years ago? And they can tell you, and then that's an IRS approved value, regardless of what the value of the real tile was. You get to use what they say the approved value was, and then reverse engineer all that deduction and everything. That's how the hotel that my clients bought for $18 million and then put $5 million into it with all the demolition and everything, that's how they paid $40,000 for a study and netted $1.6 million first year tax savings.
Mhm.
because of exactly what you just described.
Okay,
So scale that down to the size of your building, and that's what could be possible.
great. And that would be part of the study is like just giving them the photos, the appraisal, all that documentation.
Yeah.
They can figure that out. Okay,
Great.
that's great.
It's a great segue. It's a great segue. Here's the question. Does Jenna have to provide us, me and my team, with all of that information up front? The answer is no, she doesn't. She only has to give me the questionnaire, the online questionnaire, and either the closing statement or your existing depreciation schedule. If it's been in service as an income producing property, your CPA has a depreciation schedule that they've already created. If it hasn't been in service long enough and there hasn't been a depreciation schedule created, great. I have good news for you. As a part of our service, we're going to give you a depreciation schedule that your CPA will use to determine the annual, deduction that you're going to take for depreciation. Okay, so either way works. If you don't have the schedule, you're just going to provide us with your closing documents of when you bought the building. The estimate doesn't have to take into account any of that stuff that you just said about gutting it and all that kind of stuff. So the value proposition will be as if you didn't do any of that gutting it of all that stuff. It's just going to say, hey, this is what the fee is. This is what your tax benefit's going to be. And then as we get into the actual study, we'll ask you for all the rest of that information. Okay. So we want to get the client committed and signed as a client first. Then we're going to dig more in and provide them with the maximum value that we can. So it might, and here's what the net result might be. Let's say that whatever the fee was, that the tax benefit might be 15 times whatever the fee was. But after you provided all that information, it might end up being 20 times or 25 times what your fee was. See what I'm saying?
Mm-hmm. Yeah.
But you actually just said, you said yes to the fee. The fee isn't going to change. The fee is going to be what the fee is. You said yes to the fee that was whatever the fee was. And because you provided us with more information and we did a more thorough study, because of the information you provided, we provided more tax benefit for you. So the more that you can provide, the better it is for you. Make sense?
Okay. Yes. And I have two more quick questions. One of them, I'm getting ready to file for last year, and it will be, I think, the first year might be the first or second year we're depreciating. So the building, because I bought it in 2020. So I'm wondering, timeline for this kind of short before, tax time. Would this sort of look like a refiling or like an amendment to
Great
my
question,
filing, or
man.
is this a different thing?
Okay, BDO is our service provider. The gentleman who's the national director of cost segregation services for BDO is a close friend of mine. That's how I brought BDO to the table for Links. Okay, so they did 57,000 properties last year. Wow. They had their biggest year ever. 57,000 properties. Oh, by the way, 11,000 of the 57,000 was one guy. One guy had 11,000 single family rental properties in Oklahoma. 11,000 properties. What?
11,000 properties.
Yeah, they did all those 11,000 doors. Okay, so what BDO is telling all their clients, do you remember what I said about the law that's going to end DRC early? And if that happens, it's going to do a benefit for what? For cost segregation. And that has to do with bonus depreciation and so on and so forth.
Yeah,
remember
you get the 5 years at once. Yeah.
Okay, so what that means is that BDO is telling every single prospect that hasn't started yet with them to do an extension on their taxes because of this law. Because if you file before the law is passed, then you're going to miss out on that bonus depreciation. And then you got to go back and pay a whole bunch more fees to have BDO redo that portion of the study to get the benefit. So they're telling every single prospect who's thinking about doing cost seg to do an extension so that this law will pass, and now 100% bonus depreciation is back, whereas now it's 60%. It's 60% of the 5-year assets instead of 100%. That 40% difference makes a difference. Is a significant.
Yeah.
So you want to make sure you get that benefit. So it would be in your interest to do an extension for that reason alone, if you're seriously considering doing cost segregation. And I think it would be my pleasure to help you with that for sure.
Mhm. Okay. Oh, I had my third question
Can you make
was,
commission on your own deals? Or is it like would Teresa need to do Jenna's deal for her?
Yeah, we are. That's a great question. I've gotten it a few times. We
I'll
have
find
been in
out.
discussion. Yeah, the past few days we've been talking about that,
Okay.
and it is. Yes, it's being discussed. So we'll figure that out.
I'll call Jason right now.
Yes, find out from Jason. I gave him what my opinion was, and then they're going to make that decision. Okay, so what are the steps in the process? Oh, did you have another one, Jenna?
I did. It's might come off a little bit shady, but I'm going to ask it anyway because I'm sure rich people do this. But like, could you
Shady.
potentially sell your own asset to another LLC that you also own? So sell it to yourself so that you can get that whole new building, like depreciation from day one, like you were talking about.
Great. Yeah, great question. No, it's not shady at all. That kind of stuff happens and goes on for sure. The form that takes is once a building has depreciated most of the short life assets, if they have done cost segregation, or if a building never did cost segregation and fully depreciated like over 39 and a half years, and now there's no depreciation deduction left, then it makes sense to sell that building. Okay. So technically, if it was two LLCs that were wholly owned by you, the IRS says those two LLCs are disregarded entities anyway, and you would own them. So it wouldn't change anything for you. It wouldn't give you a new tax basis. It would have to be a new taxpayer that is the owner in order to reset that. Okay.
Mm-hmm.
In the event that someone passes away and then leaves it to someone else, now it has a new tax basis. So wouldn't help you to sell it to your own LLC. But if it's owned by someone else, then that changes things.
Got it.
So
Okay.
and oh, by the way, that's why people do very extensive estate planning, asset protection planning, using different entities, using different kinds of trusts and all that kind of stuff. A lot of that has to do with these issues we're talking about depreciation deductions and tax basis and all that stuff, right? That's very high level planning for wealthy people, and they make use of what you're talking about in lots of different ways to maximize or minimize their tax over time. Hope that helps. Okay.
Yes.
All right. So I'm sure most of you have been reading this. What are the steps in the process? So we need a questionnaire. That's number one. Provide the necessary documents. And the necessary documents are, there's two necessary documents, one or the other. One is, as we talked about, current depreciation schedule or closing statement, closing documents. One of those two has to be provided. All the rest is optional. Any of the other stuff that we ask for are optional documents, which I'm going to give a list here in just a minute. But the bare minimum is the questionnaire and closing documents or current depreciation schedule. Okay, so we create a complimentary benchmark analysis, 3 to 5 business days. We come back and we schedule a time with that client to go over that. You as the representative are happy to allow you to participate in that meeting. I would recommend that you do. I would recommend that you maintain close contact with this client, because this client, once they're happy and once they're a raving fan, they are going to be a great resource for referrals. Someone who owns commercial property knows other people that own commercial property, right? So we want to make sure to maintain that relationship. You don't have to be the expert. You only have to be the connector. Connect them to the expert with cost seg and with everything else that we do on the Links platform. Just be a connector. Become an expert at being a connector and creating those long-term relationships with those clients so that they will be a constant stream of referrals to you. Then we work with their CPA. The CPA gets comfortable with us and our process and you, and guess what? The CPA then starts to refer you other clients. What happens when that happens a few times and then you get some referrals and now you've got 3, 4, 5, 10 different CPAs that are referring you clients each and every year. And one thing I know about people that own commercial or income producing property is that what do they like to do? They like to buy more. They like to buy another property next year. In a couple of years, they'll buy another one and another one. And guess what? It just keeps going and going and going and going. And next thing you know, you've got a recurring income stream from the referrals and from people expanding their portfolios of properties. Okay, so they signed the engagement letter electronically, and that from that point forward, we're engaged with the client, and now we're going to start the process of doing the study. The engineering computations are conducted and applied. That might take the form of one of the engineers going to the property in person.
Wow.
In many cases. In some cases, we can take care of most of it electronically through documentation, photos, videos, so on. The timeline is typically 4 to 6 weeks. I've seen it go much faster than that. The fastest one I've ever done is like 10 days. The longest one that's ever happened has been several months for a large building, or the hotel, for example, took maybe 3 months. Smaller projects can be done quicker, and projects not requiring a field or site survey can be completed in a much shorter time frame. So sometimes that engineer is able to get all the data and information that they need. This is something, that last point on there is something that dramatically changed and improved through the pandemic. As travel was very limited, everyone seemed to get a whole lot better at using electronic means for virtually everything, right? Zoom meetings like this and everything else. And so what happened was that it became much more routine for them to use videos, photos, and so on versus having to go to the property every single time. And so in some cases, if they have enough information, they can avoid having to go in person to the property. Okay, what's it cost for a study? Whoops. Are we going the wrong direction here? Here we go. How much does it cost? Well, there's four reasons or 4 factors that factor in to how much does it cost. Well, how big is the building? The size of the building. How complex is it? What type of a property is it is going to determine how complex it is. If it's a warehouse that's empty, not real complex, not a lot of components, but a car dealership that's got all kinds of fancy lighting and finish out and tile and glass, and then that's much more complex. So that could make it more of a cost. Where's it located? Is it in Alaska? Is it in Canada? Is it, oh, by the way, it doesn't have to be in the United States, just so you know. If it's a U.S. taxpayer or a company that is a U.S. taxpayer and they own a building in Dubai, guess what? We're going to Dubai. Yeah, we're going wherever that property is. Wherever the property is anywhere in the world, as long as it's owned by a U.S. taxpayer, it can depreciate and cost segregation can apply. All of that is factored into the cost, though. So like if they say, hey, we got this building in Sydney, Australia. Okay, well, part of that fee is going to be the travel expenses for that engineer to go there, right? And if it's in a really cool place, trust me, they're going to go in person. They like to go to cool places. The last one is availability of pertinent documents. So the more documentation they can provide, it says less documentation means it's going to take time and money to reproduce some of that documentation. So if you don't have all the documents, then some of the stuff for the study has to be recreated by that engineer. So the more that your client can provide, the better, and the lower the cost is going to be. We offer a performance guarantee of 200 to 500%. What's that mean? That means that the bare minimum is going to be 2 times the fee. They're going to pay for twice as much in taxes for half as much. So for example, $10,000 fee, $20,000 tax credit, bare minimum. If not, we're not even going to present the case. We're going to say maybe it's not the right time. Maybe we should wait a little while, whatever. Maybe till the building changes or you do this or that or whatever. Come back and let's review it later. But if it's not at least a 200 guarantee, we're not going to do that. 200 to 500% is very, very routine. A whole lot of the time, it might be 10 times. And as I mentioned, in some rare cases, it might be 40 times or even more than that. I know there's stories of people with much more than 40 times benefit. Okay. Other considerations. Will it cause an audit? here's a great answer. No, it won't cause an audit because it's putting the taxpayer in compliance with what the IRS says they have to do. Remember I said that? Remember I said that that they require segregated depreciation in order to remain in compliance over time as they manage that building. The more years they go with straight line depreciation, the more mistakes are going to be made on that depreciation schedule, and the more out of compliance they are. So if they have a cost segregation study, they're immediately back in compliance. And the answer is no, it's not going to cause an audit for them to do that. If I'm audited, do you provide audit protection? The answer is yes. Wow, that's a, come on now. We need a yay for that one. That's BDO. That's not Lynx. BDO will provide 3 years of audit protection. If they're audited for any other reason outside of cost segregation, if they are audited at random, remember 1% to 2% of all business tax returns are what? Are audited at random. You win the lottery, they drew your name out of the hat and you got audited. And if you have a cost segregation study as a part of that random audit, BDO will be happy to represent the study with the IRS. Pretty cool. Here's how that goes usually. It's a phone call. It's 30 minutes. The auditor calls. The study itself is designed using the audit guide that auditor is going to use to ask the questions about the cost segregation study so that they're like in unison reading from the same hymnal in church. You remember hymnals in church? They like got the same book and they're saying, okay, well, what about this? Okay, go to page 5 here. What about this question? Okay, go to page 7, so on and so forth. 30 minutes later, they say, hey, thank you very much. Looks like you did a great job. I'll move on to the rest of my audit. That's how it goes. And that's why they're willing to offer 3 years of audit protection, because it's basically a 30-minute phone call and it's done. And so they do that each and every year for a handful of clients that get randomly audited. And they have a perfect track record. They have never had a client that's had to give back anything that was a deduction as a result of their cost segregation study. Pretty awesome. That's another reason why they do the 3 years of audit protection. And oh, by the way, why 3 years? Because the IRS can review it for up to 3 years in arrears. They can audit returns 3 years in arrears, unless someone is charged with fraud. Then they can go back an unlimited number of years. Are there other benefits? Well, we talked about what some of the other benefits were. We won't go through those again.
May I ask how old is BMO again? How long have they been doing this?
BDO, they're way over 100 years old. They're one of the largest tax accounting firms in the world. They have over 1,200 offices across the world. They did 57,000 properties last year. There are, in the accounting world, there used to be like the big 6 accounting firms and so on. Now there's kind of 4 giant accounting firms. BDO is usually 5th or 6th largest in the United States as far as accounting firms. However, they are one of only 3 accounting firms that are approved by the federal government to provide accounting work for the federal government. Pretty cool. So that, you know, that carries some weight to it. You know, hey, BDO did the cost seg study and, you know, they're talking to them because of this audit or whatever. You know, that helps for sure. Oh, as you see on the bottom here where it says property taxes can be challenged with our study. That's a pretty cool one. So the property taxes, many times, you know, people challenge, oh, you know, the value, you're charging me too high of a value. And so my property taxes are higher than they should be. And they, you know, challenge it and so on. It's a whole different thing when you say, hey, I had a cost segregation study. And not only did they do an appraisal, they did an appraisal on steroids, and they valued every single piece, part, and component and all the land improvements of my property. And this is what they say, and it's less than what you say. That usually works out a lot better, and it can decrease the property tax. The same exact thing applies to replacement value when you're talking to your insurance company for insurance. If the building burns down, right? I think I wouldn't wish that on Jenna, but Jenna, if you had a fire and it burned down, right? You're paying insurance premiums based upon what they say the replacement cost is. But what if you have a third-party company that says the replacement cost is less than what the insurance company does? Is the insurance company incentivized to say that your building is worth more or less? More. They want your building to be worth more so they can charge you more premium for replacement value. But if you go to them and you say, hey, I've got a third party that valued every piece, part, and component of my building, and they say it's worth this, I want this much insurance, not that much insurance. Now your insurance is less. So now we've saved you money on your property tax. We've saved you money on your insurance cost, which in turn changes, and we've saved you income taxes. So now your business as a whole isn't making quarterly estimated payments anymore on your income tax because you have a what? Tax credit. So your cash flow is improved in 3 ways: taxes, income taxes, meaning quarterly estimated payments. We've improved your cash flow with what? Property tax, potentially, and with insurance cost. All of those things factor in. What if you're buying a new building and we provide all this information to the lender? And now your cash flow situation looks better to the lender and they understand it. And oh, by the way, we know lenders that do understand cost seg and everything I'm talking about. Isn't it true that they might be willing to give you a little better interest rate than someone who has no idea about cost segregation? The answer is yes. In fact, we've seen as much as 2 points less on financing when utilizing cost segregation because of the improved cash flow on the property. Holly Woods, go ahead.
Can you use that as that income as offset for the down payment, maybe for properties, for investment properties? Do you know?
Could you use what? Use what? The
The
tax
offset
credit?
of the offset of the taxes improves your cash flow. Because one thing about investment properties, you usually have to put down a larger amount of money, like 35%
Yeah.
or something.
Depends. Yeah, it totally depends, but yes, it can be. Mm-hmm.
Okay, awesome.
Yeah. So yeah, the bottom line is that your file, which you're shopping with multiple lenders, by the way, you're not just going to one place. You're going to present this to multiple places. You're just making that file look better so that now there's going to be more of a competition and you're going to get improved terms. Whatever the improvement in terms is great, right? But you're going to have a better position to get better terms. Down payment, interest rate, term, whatever it is, right? All those terms can be improved when they see better cash flow situation. So what documents are required? Well, what did I say before, guys? Take a screenshot of this one or a picture or write it down. Depreciation schedule. If the property is in service. Someone asked a question?
Sorry. May I have the slides? I got muted. May I have the slides? Because these would be great. Some of these would be great to format some social media post off
Yeah.
of. Thank
Sure.
you.
Sure. Yeah, happy to do that. Yep, I can provide you with a PDF. I'm making a couple of little updates here and there, but yes, I can send you the PDF. Okay, current depreciation schedule. This is only if the property has been in service and a depreciation schedule has already been created. Or if not, you would use the closing documents or HUD statement. What are desired documents? Well, the appraisal. If you bought the property, how about the appraisal? How about the property tax statement? How about construction drawings and invoices if it's new construction? How about AIA G702 and 703 if it's new construction? Master and itemized subcontractors pay request. All these things are like, hey, if you hired a contractor or a general contractor to do a major renovation of your building, all that kind of stuff, they're going to provide you with these types of documents as a part of the quote or as a part of the pay request, itemized pay request, which will list out each and every one of the components and so on. Yeah, all that, anything that is provided is going to be included in the study and will improve the net result of the study the more that can be provided by that client. So now what? Well, be proactive. Here's the question you want to ask yourself. Do I want to help my clients minimize their taxes as much as legally possible? If yes, then what? Well, you want to complete a questionnaire for each property with a cost basis of only $25,000 or more. I want to make this really clear. The reason that BDO is a perfect fit for us and that the relationship between BDO and Links worked well, given our situation, is because number one, they have a ton of credibility. They've been around forever. They are the biggest department out there. They did 57,000 properties last year. And they're one of the big fish in the space. And none of the other big fish do small properties. All the big fish, the big 4 accounting firms or any of the top, usually the top 10 biggest accounting firms, if the building's not worth $1 million or in some cases $5 million, they won't even do the cost seg study because CPA firms like that generally charge hourly fees for doing the work. And the value proposition doesn't work. Because my friend Jeff came on board with them after having his own company for 25 years. He focused on doing a lot of the smaller properties that the big firms wouldn't do. So think about the ERC marketplace. In the ERC marketplace, there was ERC specialists, which was the giant, 800-pound gorilla in the space. And then there was all these little tiny providers. Remember how that was? And remember how much we charged? We charged what? 15% for our ERC, right? 15% of whatever the credit was. Were there other smaller providers that would charge less?
Yes.
Yes. Some providers charged what? 10%. There was other firms out there that charged 10%. Why? What did we say to clients as to why they should use us and not the firm that charges 10%? Well, I think the answer would be is that we provide a higher quality of service, right, Holly?
It was the reputation of the processors.
And also the
There you
fact,
go.
yeah, like who we had on our advisory committee, as well as the number of cases we were processing.
There you go. So with cost segregation, it's the exact same story. The difference here is that we aren't charging a contingency fee. We're not charging a flat 10% or 5% or whatever. Each case has to be individually quoted because there's such a wide variation of factors for each property. If that makes sense for you guys. So for that same property, is it possible that they could have gotten a quote from someone else to do it for a little less? The answer is yes, they probably could. But we're in the business of selling Mercedes-Benz, BMWs, or Rolls-Royces and not Fords and Chevys and Yugos, right? We're selling a higher quality product. Both might get you to your destination. But if you get audited, trust me, you want BDO on the other end of the phone instead of the Chevrolet or the Yugo.
How do I
Right.
know that the cost basis is 25K? Like, what does that property need to be worth overall to make that?
Great question. 25,000 in depreciable cost basis. This just means, well, and the reason that we say 25,000 is not because there's a house or a property that's only worth 25,000. This works for tenant improvements. You want to write that down. Income producing property is not just property that you own the whole building. If you lease a space and you put $50,000 in tenant improvements into that space, guess what? Those $50,000 of tenant improvements depreciate on your taxes as if you owned the building. You do own those assets. Those are improvements. So if someone has at least $25,000 of tenant improvements, then we can do cost segregation on that. Okay. So that's why it's 20, we set it at 25,000.
Okay. So if
it's
you
less
had
than
like
that, it doesn't make sense.
if you had an individual townhouse or something, as long as it's more than $25,000, then you should put it through.
Yeah. As long as the building and land improvements minus the land is greater than $25,000, then yes, we should look at it.
Got it. Thank you.
Usually if somebody owns something like that, they're going to have way more than just one. They're going to have a portfolio of those, right?
Yeah.
I'm talking to people. I'm talking to a guy that's got 60 commercial properties. I've got somebody with 100 rentals, 100 plus rentals. And my biggest case that I'm working on right now is 2,300 commercial properties for a Lynx representative. Crazy. Friend of a friend kind of situation. And we're chasing down this guy who's super busy and on paper, he's a billionaire. And we're going to try to close the case. So we'll see how that goes. But that's, yeah, any size. Any size. If your client has a property with total cost basis over $1 million, I put down my contact information. Reach out to me by text. Text is the best way. Text or email or call me. And let's have a little chat about the client so that I can help you with how to best approach, or, you can kind of tell me about the relationship. How well do you know them? That kind of stuff, just so we can, make sure that we go about it in the best way possible for the highest percentage chance of getting them as a client. It might be that, if the case is large enough, I mean, I'm more than happy to do like a little short, 15-minute with that client, give them some of the basics and here's why, giving them basically the only thing we're asking them for is, hey, let us do a no cost review, do the questionnaire, provide us with a document or two, 3 to 5 days. We'll let you know if it's going to be something that's worth it for you or not. That simple. We're not asking you for a fee. We're not asking you to say yes to that you're going to use this or anything like that. We just want to review what you got. Here's the last part. Make sure you write this one down. Really, really important. If someone says, you know what, I already did cost segregation a few years ago. It was great. I paid a little fee and I got some benefit. My accountant referred me to somebody or whatever. It was great. The answer is always what? Man, that's awesome. You're way ahead of the game. You're way ahead of most people that I ever talked to. There's very few percentage people that have done cost segregation, but I have great news for you. The great news is that because of our relationship with our provider, with BDO, Links and BDO, we'll review that study at no cost. We'll give you a second opinion on your existing cost segregation study, and BDO won't even charge a fee to do that review. So even if, and here's why. Why is that? The reason is because, number one, they might have other properties that they haven't done cost segregation on yet, number one. Number two, that we could do the cost segregation for them. Number two, in about 70 to 80% of the time, we can find more money that was left on the table by the previous provider. How many of you guys know that ERC specialists in some cases provided a higher ERC credit than another provider quoted? Do you guys ever remember that happening for you? I had it happen multiple times. Why is that? It's because of the calculation was done in a more thorough manner, let's say, than the other provider. So the other provider was only going to charge 10%, but they didn't spend as much time backing out the PPP loan in the right way and all that kind of stuff, right? Which would have taken more time for ERC specialists to do, but they only charged 10%. But they were better off paying us 15% because our credit supported by our calculation was higher. Does that make sense? So the same applies with cost seg. If someone is willing to do a cost seg study, or maybe they already did a cost seg study and they paid $5,000 for it, they may have only went and got the easier, let's say 50, 60% of all the value that was available and left the rest on the table because it would have taken a lot more time. And oh, by the way, they probably would have had to go to the property in person to get the rest of all that information to give that client all the benefit. Now there's half of the benefit left over, and we can come back and say, hey, you already paid $5,000 for the other study. We'll charge you, whatever it is to update your study. Let's say it's another $3,000 or $4,000, but for that $3,000 or $4,000, we're going to provide you with another $50,000 of tax credit this year. Okay, so we will review any existing cost segregation study on any property for that reason. Does that make sense for everybody? Okay, what else?
Any other
What's
questions?
in it for me?
Well, I'm fired up. What's in it for you is I think that all of us should consider having a one-on-one with our top 10 or 15 people that we can help with this.
There you go. That's
Yeah,
going to be
and
the call to
also-
action.
Also, if they don't have multiple properties or the property is less than $1 million, then go ahead and fill out the questionnaire. Once you fill out the questionnaire, Clint gets that information and he
Yep.
will be able to best advise you on what you need and how long it's going to take and all that good stuff. But also
Yep.
our back office team here in Vegas, they're also getting trained on this. You've seen Mo and Tracy on here. They are two of the gals that work here in our back office. So they also are getting trained up on it as we continue to move forward. So they will be able to start answering some of those questions too, because when we do have you calling, each one of you calling with your top 10, but there's 1, 2, 3, 4, 5 5 or 6 agents on, that's 60 calls. That's going to keep Clint pretty busy. So let's make sure
Yep.
that they either own more than 3 properties or they own a property that's over $1 million. And obviously, if it's like the first one you're doing or whatnot, and it's smaller than that, then Clint can help you with that. But
Of course.
if it's once you get going on it, let's, learn what you need to learn. As Clint said, you don't need to become the expert. He's the expert in this, and he's going to be able to walk you guys through it.
Absolutely. And so that's it. If you guys have seen this, it's a 18.33% is 100% level in the AF comp plan. So that's 18.33% of whatever the fee is that we quote. If someone has multiple properties, the quote will be combined together. So we won't be doing them separately. It'll be like 5 properties. We'll have separate quoting for each one and then a combined value proposition at the end of it. So we'll show them each individual property. Then we'll say, hey, this is the total fee. This is the total tax credit. And that fee is what is 18.33% is what goes into the grid for you. The average fee per property is $8,000. That equals around a $1,466 commission. Average client usually has 2 to 3 properties. And so you see the range of commission there. If it was 2 or 3 properties, it's going to take approximately 68 properties, give or take, to make 100 grand with cost seg. And if you do 68 properties, I will promise you that those 68 properties are going to multiply over time because those people are going to buy more property. So next year, you're going to go back and do cost seg with them again on their new property, and they're going to refer you to some other people. So you're only going to take 23 to 34 clients per year to make 100 grand with this. So how many hundreds of thousands of dollars do you want? Last thing I'll say is, if you do the referral thing in the right way, you're going to get referred to someone who refers you to someone that ultimately refers you to that one other person that has 100 properties that you never would have had a chance to talk to if you hadn't been involved in these conversations. And oh, by the way, that person has 100 properties. They also got 50 or 100 W-2 employees in their company. And now you can go and talk to them about lots of other things too. And those are people that you never would have talked to if you hadn't been doing cost segregation. So that's the best case I can make. Yeah, best case I can make.
Is
Questions?
the runway on this unlimited? Meaning this has to be done technically to be in compliance. So is this for like the next 25, 30 years, or is this for the next couple years?
Great question, Karen. So the cost segregation study technically has to be done once, just once for that property. However, when the roof is damaged 2 years from now, someone has to do the accounting to update the depreciation schedule, and that will result in a fee, and that fee will carry with it a commission.
Okay, but even
Deliver-
besides that, I'm just trying to figure out, like, ERC was a set number of years and now it's like done. Is there
Oh, you're asking how long is it going to go? Oh, you mean the runway? You said run rate. Okay, the runway.
No, I said
is-
runway. I just didn't. I probably, sorry, I slurred.
Okay. No, there's no end in sight for cost segregation.
Okay. So
They're
we can
just at-
bring in
they're-
new clients all the time.
Been going since 1987.
Yeah, I
Excellent.
mean, you cannot say never because as you saw
Right.
with PRC, somebody got their hair twisted and they wanted to stop it. They got on a big, kick for it, took it to the Ways and Means Committee, and it was gone pretty much
Yep.
overnight for us, unfortunately. However, this program and some of the other tax programs that we have available now, like the R&D,
Yeah.
they've been around for 4 or 5 decades. And so
Yes.
they really aren't going to be going anywhere as far as we can see, but we will update you as that continues to be updated.
The ramifications of eliminating cost segregation completely would be way like a factor of 1,000 bigger deal than eliminating ERC. Like it's basically can't happen with our current tax system. Like it would just be an absolute mess that would take forever to fix. So it's just baked into the cake. It's baked into our tax system so much that they've played with adjusting this whole bonus depreciation thing. They sweetened the pot and made it better and did this 100% depreciation thing, in 2018. So it went from 1987 until 2018 without that benefit. They made it 100% bonus. Then they put it on a schedule to sunset. So it was going, 80%, 60%, and so on, all the way down to 0%. Now with this new law, they're putting it back to 100. So the indication is that it's something that is a good thing, that the powers that be, those that are in power that are making the laws, some of those folks own commercial property and they're sticking this in there. And all those that don't own commercial property are like, I don't understand what this is. Why? Okay, yes, I'll vote for it. So there's no pushback against it. Those that it benefits are fully in support, and there's nobody who's like, hey, that's something that I'm against. Nobody's against it. So I would say it's going to continue.
Thank you.
Awesome.
All right,
Thanks, Mark.
guys. Anything else?
No, that's it. I have another call on this line starting in a couple minutes, so we have to go.
Very good.
Thank you
Very
so
good.
much.
It was a
Glenn.
pleasure talking to
Appreciate
y'all.
your time.
Thank you.